Hey traders, welcome to Charts and Coffee. Hope everyone's having a very good Tuesday morning. Let's take a quick peek at the economic calendar as we kick off the morning, August 27. It's pretty open except for one number. And this is a number in general, a theme that we're going to be keeping an eye on from this point forward. So think of it as, say, October of last year, November of last year, to August. And what have we been absolutely fixated on? Primarily inflation, right? Is that inflation flattening and cooling? And when you take a look at crude oil, you take a look at copper, you take a look at the CPI, the PCE data, and most importantly, listen to what the Federal Reserve is saying to their requirements, to their measuring stick. CPI, PCE, inflation's at a level where they can begin cutting rates. All right, so we put that aside. The other part of it was the second mandate that the Federal Reserve has, which is employment. So as you get to this inflation target, whether it's up or down, whatever it might be for that cycle, you can't break jobs, right? So when non-farm payroll was pretty lousy for the July numbers that were released in August, we'll get the August numbers the first week of September. Those numbers were pretty bad. And then the message was, all right, Jerome, you've gone far enough. You and your merry band of Fed members, time to cut rates, you're hurting jobs. Okay, that was the second one. So now that we're going to start seeing the rate cuts, inflation doesn't become necessarily as important. Unless the Federal Reserve, though, this is the tricky part, because I got this question a lot. Rog, could we still continue to see higher highs in this rate cutting cycle, and how long could it last? So there's three pieces. One, yes, we could continue to see some strength. But by the way, gang, and I think this bears some mention. If new all-time highs are mandatory, are needed, or are even part of the trading plan, that's not trading. That's a disaster waiting to happen. No trading plan should be contingent for an initial target to be needing all-time highs. That's a disaster, right? So whether or not we make all-time highs is really more of something you and I get to talk about in the morning. None of the trades we are putting on should absolutely need it. That should just be a fleeting thought. Oh, cool, all-time highs are great. For example, Coke, right? We're in a long position in the mastery in Coke. We tend to look in some different places, right? So if you're looking at staples, utilities, healthcare, that kind of place. Those are things that we look at in the sector secrets mastery because those are the sectors that are outperforming. So granted, everyone's concerned about NVIDIA and tech, and that's fine. But if you're looking at where the outperformance is, it's not in tech. Who cares what's happening in tech, to be quite frank? Our job is to find trades that go from maybe 2 to 10 days. That's it. Right. So sometimes we start to, and I'm sure I could be as guilty of it as well. We start to think about the macro picture way too much. It's interesting. It matters to my longer term holds a little bit. But for the most part, with the time horizon that we're in, these are just interesting talking points. And we like to be aware of broader market forces. But my gosh, if all-time highs are part of the trading plan, that ain't trading. Right. And I can say that without even hedging that. Please don't put yourself at a point where, for example, Coke, we bought Coke and we're getting new highs. Great. We're at our second and third target. We're going to start to ride this out. We didn't need Coke to break into the 70s to make money. In fact, we're already nicely profitable. So keep that in mind. That's a vulnerable place to be. So anyway, had to mention that. So let's go back to what it is that the Federal Reserve really has to communicate with some clarity. They've got to ditch the data dependence. That's what's going to be the path to, we're going to see cuts between September to possibly June of next year. So this is 7 meetings between now and June, September and June, that we'll be looking at a 1/4 point cut at each. That might be a little ambitious, especially if the Federal Reserve remains data dependent, meaning every meeting is a live meeting. It's not just sort of rote. They're going to cut. So we'll see. But I'm not a bear. right? I'm not a bear in this environment, and I can't imagine why anybody would be. But where are we bullish does matter. And as I mentioned before, your top three weighted sectors are staples, real estate's up in there, XLRE, utilities are up in there, as is healthcare. That's why in the Sector Secrets Master, our watch list tends to look a little different than other places because we're looking at the relative outperformance. And then, interestingly enough, let me show you here. We also now have a little bit of strength coming in month to date. This is just for August. We have gold miners coming in. This is why we've been looking at things like Newmont Mining, and we're long gold right now. That was probably one of the best positions we could be in under the sort of cloud of uncertainty with Powell from Friday. So we're long gold. But take a look here. We have communications. That's Meta. That's Google. That's telecommunications like telephone, Verizon, Charter. Below that, we have financials. Keep an eye on the big banks. JP Morgan, keep an eye on Wells, keep an eye on American Express, Goldman. Then below that, we have basic materials. Obviously, if ITB and XHB, home builders, home construction are on the move, these should go ahead along for the ride. We have tech. This is Microsoft. This is Apple. Now, Microsoft doesn't look so great, right? If you take a look at what's going on under the hood in XLK, it's nothing to write home about. But as a group, as a high concentration weighted group, it's actually up in that relative top performance sectors. And why? Well, not everything is Microsoft. NVIDIA is pretty strong. We'll get NVIDIA earnings tomorrow after the bell. Apple's doing okay. Salesforce is doing okay. Adobe, Oracle's trying to cross through some key levels. Accenture. So Cisco, it's mixed at best. So if there's any part of the broader indices that have a kind of question mark hanging over them, I'd say it's still tech. But this is where this just ridiculous focus on what's tech going to do next causes us to miss a handful of really great trades in staples, utilities, healthcare, gold miners, etc. So think about the way in which you're focusing your attention. Is it what everyone's talking about, or is it where the sector performance is? Obviously, we focus on the latter in the Sector Secrets Mastery. That's part of the name, right? Okay. So as always, if you have any questions, feel free to type them on in. Let's go see what we've got coming up this morning. So again, we have that consumer confidence number. So what now do we have to add to the conversation? Are we as concerned about inflation? Not really. Are we concerned about jobs? Absolutely. But now, all of a sudden, those consumer sentiment numbers, retail sales numbers are going to have more importance. We're going to want to see evidence that the consumer is buying healthy and employed, right? And so things that we wouldn't have really cared about even just a handful of months ago. For example, when University of Michigan data comes out, there's an inflation expectation number and there's a consumer sentiment number. And it really was the inflation expectation number that took front and center. Now it's going to be more of that consumer confidence. So we have to add those back into those hot zones that could be impactful. S&P, look, we're not going anywhere, are we? Most of August is an interesting month. If you back out the April FOMC fear mongering that a handful of members had when they started talking about rate hikes, you back that out. If you back out the absolute ridiculousness of the carry trade unwind that happened for about 3 or 4 days, you'll see here. And it wasn't just a carry trade, gang. Please remember, that carry trade issue was out there, but it was probably already a ticking, a ticking bomb, if you will, because of the rate hike at the end of April. We got another one in July, but still, we hung on. I mean, it wasn't as if the July hike from the Bank of Japan undid the market. What was it ultimately? It was the lousy non-farm payroll number in the U.S., which sent the U.S. dollar lower, and the yen strength was exacerbated, and we pushed the fifth standard deviation, which is a bonkers number of volatility, right? So this is a volatility event. And then everything calmed down because the carry trade didn't have to be completely unwound. It was an individual 1-2 punch of the second rate hike from the Bank of Japan, then coupled with a non-farm payroll miss, which caused the US dollar to weaken because we all of a sudden started hearing from these people on television that we needed an emergency meeting and there had to be a 3/4 of a rate point cut immediately. Do you remember that nonsense? We're going to get a 1/4 point on the 18th. Everything's calmed down. And so now we're back to where we were before the melee began, right? Isn't that interesting? So you back these sort of anomalies out, and the trend on the S&P, it's absolutely been dissed. This trend has been so dissed. And look at where we started the year to where we are now. And I'll tell you this, anyone who's concerned, if you're thinking, but Rog, we could head lower. Sure. But ask yourself, Rog, was I in for this 1,000 point rally for the S&P? Have I been looking to the long side, or am I just too concerned about where we could top out? That's an opportunity cost, right? And anyone who's looking at tops here clearly isn't long. Otherwise, they'd be looking at more upside potentially, and these would all be targets. There's a difference between resistance being a target because you're already long and resistance being a top because you're not, and it's a revenge trade. And that's a lot of what you're going to hear and see out there because that's what's happening. That's what's happening. So be careful, gang. Stand guard at the gate of your mind. Are there things that are weak? Sure. KRE continues to be pretty weak. In fact, if you're saying, Rog, are you saying that nothing is weak? Oh, gosh, no. Oh, gosh, no. Just please don't start your analysis off with this is topping and it's time to get short. You're going to lose money more often than not. And it's been a losing proposition the entire year, which kills me because a lot of traders are on the sidelines. They're not buying calls on dips because someone else out there is going to tell them, hey, this is the top and we're about to crash. Even the crash was greatly exaggerated that we got at the beginning of this month. So what is weak, right? Okay, Ron, but something surely out there has to be weak. Yeah, if you want to look at weakness, take a look at energy sectors, oil services, energy, oil and gas explorers. Those are all pretty darn heavy. I'd keep an eye on that. Then if you want to get a little bit more inside baseball and look at some individual industries, metals and mining is continuing to struggle. That's XME, right? And keep an eye on that. So there are some corners of the markets, meaning some individual, more niche type sectors, these industries that are weak. But this has definitely been, since the 7th of August, much more broader participation across disparate sectors to the upside since then. So when folks talk about participation, don't narrow it down to some ridiculous tick trend, whatever. No offense to those things, but who cares? Because those things measure each stock equally. They measure each sector equally. That's not how those sectors are built. That's not how the broader averages are built. So if you want to look at participation, look at something like this. Take a look at the industries that you're interested in. Make sure you're looking at the ones that are weighted within the NASDAQ, S&P, Dow, Russell, and then look to see if they're moving together or not, right? If you want to know what participation is, look at the thing. Don't look at some sort of mathematical and frankly incorrect representation of the thing. Just look at the thing, right? And if you're looking at it and you realize, okay, there are some laggy parts to what we're seeing at the moment, and S&P is not one of them. Frankly, the Dow is not one of them. Why? Because healthcare is strong, and healthcare will disproportionately benefit the Dow and the S&P. Regional banks are lagging. So Russell's not weak, but Russell, a lot of folks are also asking me, Rog, I keep hearing that small caps are going to benefit the most. Well, no. Everything likes cheap rates. So to single out small caps is ludicrous. However, everything likes cheap money. I shouldn't say everything. Companies like cheap money. Why? Lending costs, R&D, employment. Think of what doesn't benefit when money is cheaper. Pretty simple, right? On the flip side, KRE is lagging, and as is RTY. Now, why is this? Chances are for these two, for the question I get, and it's a well-meaning question, but when will these start to benefit from lower rates? When they're actually lower, right? So S&P and NASDAQ, these big international companies, can project forward, have projected forward, and they've been in uptrends before we even got the first rate cut. But the Russell's been kind of chopping about. The Russell's going to start to benefit when, if it's going to at all, when the rate cuts start to hit, right? So some will will benefit from the anticipation of, like the S&P and Nas have. And then others are sort of slowly and cautiously moving higher, because until those first rate cuts begin, I wouldn't expect to see the Russell start to really power through 2,300 until probably October, November, as the rate cut cycle is much more set. We get the first quarter point cut, and we're well on our way to maybe 3.5 to 3.75%, as low as 3.25 to 3.5 in terms of that Fed fund rate, which is currently at 5.25 to 5.5. So wait for the rate cuts. That's probably when the Russell will kick into gear, but it's not quite yet. All right. As far as performance review, yeah, we'll be doing that either late this week or early next. I'll share with you all what we did in the Sector Secrets Mastery. If you're in the Sector Secrets Mastery, you know exactly what we're doing. We send out a recap each and every day showing you all the different levels that we've entered at and all the different levels that we're scaling out at. That recap goes out every day, as well as all the day trades that we did, all the entries, all the exits. Remember, gang, if you're looking at entries and exits, you've got to have all the exits and all the entries together. Otherwise, there's no way to do the math, right? So yeah, we'll be doing that either late this week or early next, Graham. What factors motivate the gold market to bullish, David? Well, it has been for the most part, because we have not only the rate of inflation moving lower, but we also have the lower end of the yield curve, the nominal yields of, say, a one-year bond moving lower. When the chasm between those two narrows and they're moving lower, that's going to be bullish for gold. And you can see gold's been bullish for some time, and we're just continuing to take advantage of the long side as long as the candles are green or yellow. All right. What are the stock proxies for the big four indices? Gwen, I wouldn't reduce the big four to a stock proxy unless you want the ETF. So I'm not quite sure so to me, a stock proxy would be what is a heavily weighted stock in each one of them, but I would never reduce the S&P to a single stock, right? But if you're asking what the ETFs are, QQQ, SPY, IWM, and DIA. And then take a look at the sectors weighted within them. All right. Jazz says Coke was a killer. Did not, we'll have another one. This is our second go round with Coke. This is our second go round. So we have the September 20 options. Before we had the August, 16 options. So we're continuing just to keep with the overall trend that we have on the daily time frame. And again, don't be afraid to take a look at things in healthcare, utilities, staples, gold. These are the places that, again, you're not going to see them talked about on television. And frankly, other traders are really not going to be looking at them, because most of the time, tech is the focus. So tech will be the focus eventually again, but it's just not right now. Yes, we have NVIDIA earnings coming, but guess what? Who cares, right? I mean, I say that very sincerely. Who cares? Let it happen. Let's see where it is when it's done. And in the meanwhile, I'll very happily make money in Coca-Cola, and gold as it moves to the upside. And these two don't give a rip about what happens with NVIDIA. So sometimes, gang, if you're running west looking for a sunrise, you're just not going to get the results you want. And a lot of traders just wake up looking at what they're told to look at, right? What's being discussed doesn't mean that's where the opportunity is. So yeah, NVIDIA might go up, NVIDIA might go down. It's a heavily weighted stock. It's going to have an impact on the NASDAQ, the S&P, semiconductors, and the technology ETF. So QQQ, SPY, SMH, and XLK. But we don't have to trade in those four places, right? Do you think Newmont Mining and gold gives a rip about NVIDIA? Nope. Do you think Coca-Cola and the XLP gives a rip about NVIDIA? Nope. What about healthcare, right? So while there's broader implications of risk appetite and risk aversion and heavily weighted stocks can influence it, please remember, just because it's being talked about doesn't mean that's where the opportunity is. I'll go try to find the Cokes out there. I'll try to go find the healthcare and the staples sectors. What's going to move? And then ask yourself, what impact could something have? And do I have to trade it? You really don't, right? There's a lot of freedom in that. All right, gang. As always, thanks for being here. Drop some truth bombs on y'all today. Hopefully that's going to point you in the right direction. If you need some help with that, come join us in the Sector Secrets Mastery. We do it each and every day. All right, gang. Be good to each other. I'll talk with you soon.